What's up, everyone? Today we're gonna talk about how to use rental income to qualify if it's at the time of purchase or in the future. I'm here with a great lender, a friend of mine, Jeremy. He will guide you and answer all the questions that I have and to educate you. If you like this topic, please stay to the end because we're gonna drop a lot of gems for you. Thank you so much, Jeremy, for coming to the this episode. Yeah, absolutely. Tell me your company name and how long you've been in business.
I'm with Prime Equity Mortgage. We're a wholesale mortgage brokerage based out of West Covina. I've been in the mortgage business for about 4.5 years now.
Sounds good. That's a very good period. So, Jeremy, the first question I want to open up with is: can someone buy a single family home with an ADU on the back, regardless if it's permitted or not permitted? Can they use the rental income from the ADU to qualify at the time of purchase?
Yeah, great question. So when we're talking about the new purchase, the subject property that they're buying, regardless if it's permitted or not, that ADU will give the house value.
Yes.
But they will not be able to use rental income, future rents, basically, if saying that they're going to rent out that ADU in the future as extra income. They're going to have to buy it without any rental income. In the future, if they were to put a tenant in there, just if in the future, if they were to put a tenant in there, rent it out, now that's on their tax return as income, they can use that actual income on top of their earned income with their W-2s or tax returns to qualify for that purchase price. But when it's just a accessory dwelling unit, a single family residence zoned as a single family residence, you're qualifying for that subject property with just your income that you already have, no future rents on that.
Got it. So, Jeremy, how about in the future when someone is already living in the property? Again, it's a single family with an ADU on the back, and then they want to refinance in a couple of years. And
Yes.
they reported the income.
Yeah, so after you've owned a property for a year, they're going to want to see, what you reported on your tax return, your Schedule E, Schedule of Real Estate, your rental income. If you rented out an ADU, even if you rented out a room inside your single family residence, if that's reported on your tax return, your personal tax return, you can use that as extra income to qualify either for that refinance or for another purchase in the future.
That's good.
So you have to have already had a history of renting out that accessory dwelling unit in that single family residence. Yes.
So my follow-up question is, can we use the rental income if we are purchasing a duplex?
Yeah, absolutely. So now duplex, totally different scenario. This is zoned differently. It's R2 zoned as two separate units legally. And if you're telling the bank that you're going to, on this new purchase, live in one unit and rent out the other unit, they will actually give you future rental income to actually as extra income to qualify for this purchase price. So, for example, say that other unit that you plan to rent out can rent for $1,000 a month, market rents. They're going to give you 75% of that, so $750 on top of your earned income to help qualify for that. It will be included in your debt to income ratios.
Got it. That's actually really good. And you pay a lower down payment if it's owner occupied.
Absolutely, yeah. Owner occupied. So if you're gonna buy it, they have programs where if you're buying a duplex as a pure investment property, they're gonna give you 100% of both units.
Oh, okay.
And no income documents needed. That's maybe a topic for another day.
Yeah, absolutely.
Non-QM loans.
Yes.
DSCR loans.
Yes.
But when you're buying
tuned,
it,
guys, for this episode.
But when we're talking about Fannie Mae or FHA guidelines, buying it as your primary residence, you want to put a low down payment and also get the best possible interest rate. Now, when we're talking about a duplex, they'll give you 75%
of the second unit.
The second unit that you intend to rent out.
Got it. That's good. That's really, it's gonna boost your buying power because you don't have to come up with all down payment.
Yeah. So say
the payment.
For example, it's a $1 million purchase price, and you're approved for 950,000. Now, when you actually are buying a duplex and you have that extra income from future rents,
Yeah.
that's gonna maybe put you over where you need to be.
Like 1.2 or like 1.3 purchase price.
And also, with the duplex versus a single family residence, loan limits are higher too. So
yeah, exactly,
yeah.
because it's zoned differently. So that's good to know. Thank you for sharing. So Jeremy, I know that there are so many ways to like help the buyers reduce their payment. Tell me more about the ARM loans.
So what ARM stands for is adjustable rate mortgage.
Okay.
It's a second option to a 30-year fixed. What it essentially is for a certain period of time, whether it's 3 years, 5 years, 7 years, sometimes 10, it's going to be fixed for that certain period. After that fixed period, it's going to adjust with the market, whether the interest rates go up or interest rates go down. I personally don't like adjustable rates because I rather do a 30-year fixed. Gives that much more certainty.
Yes.
You don't know where we're going to be 3 years from now.
Okay.
And if, say, rates go up, you're already grandfathered into that fixed rate.
Exactly.
If rates go down,
then you could refi.
Possibly refinance to that lower rate, assuming
Exactly.
your credit is still in good shape and you still have that same income.
Okay. Yeah. So tell me more about the qualification. Do you qualify for the rate, the current rate, or should they qualify you for the after the adjustable rate expires? Like
there's probably different overlays.
Okay.
I personally don't do a lot of them. Don't want to get too in depth in it, but
Sure.
the pro and con obviously of doing this loan program is you're essentially getting a slightly lower interest rate.
Okay.
Because you're only fixed for a certain period.
Okay.
But the pricing is not too much lower.
Favorable.
Yeah, it's maybe an eighth lower than a fixed rate right now from what I'm seeing.
Yeah.
And just the risk versus reward, I rather just go with a fixed mortgage. But yes, they're going to qualify you with today's rates.
With
basically.
today's
Yes.
rate. Got it. Do you know any programs that they pay only interest in a certain
Yes. Yeah, there's a lot of programs that's an option.
Yeah.
Whether you're buying an investment property or even a primary residence, there's interest only
loans
options. Yes. Yeah. Yes. Very, very common with our investment purchase on a DSCR loan where and that maybe another conversation for another day.
Stay
Again,
tuned.
non-QM. Don't want to get too in depth with that, but basically say the idea of a DSCR loan, debt service coverage ratio, you're buying this as a true investment property, 100% of the market rents has to cover the total payment.
Okay.
Now, in instances where it doesn't cover that payment, you can take a 10-year interest only option, which is basically going to be slightly lower payment to make that self-sufficient.
Sounds good. And then that 10-year, when you qualify the people, do you qualify them for the 10-year or you qualify them for the interest rate?
It's going to be qualified with the interest only payment, payment to make
Got
that
it.
work.
Okay.
And then after 10 years, it's going to go into a fully amortized principal and interest. So after 10 years, we want to see if you want to keep that rate or if
refinance.
Refinance depending on where the market's at.
Because of the interest rate are so high, it might be feasible to do only interest only for certain situations, and then in 10 years hopefully the rates are going down and you could refinance into a more favorable term.
That's correct. It's going to lower, the overall payment. And when we're talking about an investment purchase, it might actually, even if you don't need it to qualify per se, it's going to help increase the cash flow.
Okay.
So sometimes, investors want to just do interest only where that payment is maybe a few $100s lower. So that way that's a few $100s more cash flow from this rental property.
For this time period.
Versus a principal and interest payment. Yeah.
Exactly. Sounds good. How about zero down payment mortgages? Tell me
so
more about
there's there's plenty of options where you can get 100% financing.
Yes.
Down payment assistance loans. So many different types of down payment assistance loans. Essentially, the bank will lend you a whether it's FHA or conventional, about 95% of the purchase price. And then we're going to put a second mortgage for that down payment that you borrowed. The only thing is that it's going to be at a slightly higher interest rate and paid off in a much more aggressive term.
Okay.
So it does cut into your buying power a little bit, but this is a way where if you don't have funds, you can actually still get 100% financing. And as opposed to the best 100% financing loan out there is a veteran loan, a VA loan.
VA loan.
That's 100% financing as well.
Awesome.
But for the average, civilian who didn't serve in the military, there still is down payment assistance loans. Yeah.
Sounds good. So stay tuned for the VA loan episode.
That would be a great one. Yeah.
Yeah. Thank you so much, Jeremy, for this lovely talk. I really appreciate it. I hope you guys learned a lot, just like myself. If you like this video content, please share with family and friends so they could get the benefits. I will see you in the next video.